So once again, good evening to all of you, and I am going to start the session now. In the last week of this event, so we are in the fourth week of this event, and today you are learning the delta neutral strategy. Tomorrow we have the program on pair trading, and the 23rd, the last day of the event, we will be learning on the beta decoupling method of pair trading. So today our objective is to learn the delta neutral strategy. So that is what I am going to explain now. So delta neutral strategy, whenever we are forming, we should delta is one of the Greek associated with the option. So here once we are going for the definition of delta, this says that change in the option price with respect to the change in the underlying asset price. So delta of a option, if it is saying that the delta of that option is 0.5, if you are saying that yes, the delta of this option is 0.5, that means it's 1% change in the underlying asset will give you a 5% change in the value of the option. Suppose delta of a, you can say Nifty is at a 8,250 and you are, this is the Nifty future and 8,300 call option if I am saying that, and its delta if I am saying that it is 0.45. So if this is the thing I am getting, then I can say if this Nifty changes by 1% in the upward direction, then the 8,300 call option will move up by 45% in the upward direction. So that is what the meaning of the delta is. The percentage of movement given by delta is more. Same way also it has a percentage of fall. So you can say whenever your prices are falling, whenever the prices of this particular instrument is falling, then delta also will impact in the downside direction in the same way. Suppose you can say same Nifty, if it is falling from 8,250, if it is falling down by 1%, then you can say based on the same data of delta of 0.47, the 8,300 call option premium will fall by also 47%. So this is what the meaning of the delta is. And delta of a future is always 1. Delta of a call option varies from 0 to +1. Delta of a put option varies from 0 to -1. So these are the delta of the call option, put option and the future. So you will get a number. So call option means you will get a number from 0 to +1. For put option you will get a number from 0 to -1. For futures you will get 1. So this is how the delta will be translated. And what is the delta neutral means? Whenever we are forming any strategy for delta neutral perspective view. Delta neutral perspective view. So what actually we used to do? Neutral doesn't mean that delta should be 0. Neutral means you need to reduce the delta effect to a level which is comfortable to you. So you can say if I am just buying 8,300 call option currently which is quoting at suppose 50 rupees or 55 rupees it is quoting, and its delta it is saying that 0.47. So if this is the option 47, if this is the option I am just purchasing, what will happen? I am taking a 47% of risk for buying this option. Means for if the Nifty fall by 1%, my option premium which is 55 will be falling by 47%. So this is what the delta meaning is, right? And you do not wish to take that risk of 47% in your trade. So how you can manage that delta? How you can reduce that delta effect so that you'll enjoy all the profitability associated with 8,300. Same time, you will not be exposed to the risk of 47%. So for that you have to form a strategy, or you have to form a strategy which is known as your delta neutral. So whenever we are forming a net delta neutral strategy, our aim will be whether the strategy should give us profit in a upward trend, whether the strategy will give us a profit in the downward trend, or it should give us a profit in the range bound trade. So these are the three things you have to concentrate on. So whenever we are talking about a upward trend, that time the net delta you need to derive at positive. When our anticipation to make the profit from the downward trend, we have to derive the net delta which will be negative. Whenever we wish to make profit from a range bound trade, then we have to form a strategy with net delta to be 0 or near 0 level. So based on our objective, we have to keep this delta neutrals, net delta level in our risk comfort level. So delta neutral strategy means keeping the net delta at a level which is comfortable to us. So that is what the delta neutral means. So now having a trend positive, trend negative or trend neutral approach for delta, that is based on the market's approach. So how you will know that market is in a positive trend, how you will know that market is in a negative trend, or how you will know that market is in a risk neutral trend, that time you can say that the Fibonacci helps you a lot in that. So many of you will be getting our weekly newsletter on the Nifty as per the one standard deviation. So one standard deviation is also one of the way to identify the trend. So one of the way to identify the trend. So if you are having that newsletter and if you are going through those newsletter, I used to say that this is a range bound trend identification if the price moves in this particular band. So whenever price failed to cross this 0.618 retracement either in upside or downside, we used to say that yes, this is a sufficient cause to say that it is a range bound trend. Some cases you will say that whenever the price failed to move at least in the range of the 0.236 retracement, or neither gives a uptrend breakout nor gives a downtrend breakout, then also we can say that it is a range bound trend. So many processes are there to identify a range bound trend. So that is one aspect. How you can say that it is a bullish trend or a bearish trend? On closing basis, whatever previous day's close was there, whatever the close you are happened today, on closing basis, if you are finding out the prices is above the death zone as per the Fibonacci principle, means above 0.786 retracement, then it is a trend, is a bullish trend on closing basis, on inspection of your closing basis. So 0.786 retracement level, if it is constantly closing for a day or two, then you can say trend is up. Similar way, if it is constantly closing in the 0.786 of the downtrend level, then you can say that the trend is down. So this is how you can estimate the trends as per the standard deviation, one standard deviation formula. Similar way, you have many other processes. You can utilize Elliott's principle, you can utilize Gann's principle. So based on that investigation, you have to find out the instrument what you are choosing for the trading, or choosing to form a delta neutral strategy. Either it is in the upward trend, or in the downward trend, or in the range bound trend. So you got that first hand information. Once you get these three information, your instrument says that yes, it is in upward trend or downward trend or in the range bound trend. Next process what you have to follow, that you have to form a delta neutral strategy. So that doesn't guarantee you, yes, previous data says that yes, 2 days it is closing above 0.786 retracement, trend is up. So that doesn't guarantee that third day will never be a negative day. That doesn't guarantee that the during your process of holding for 4 to 5 days, it will never become a range bound day. So range bound day or the range bound action on that script or the negative action on a script or based on your adversity of that expectation may happen at any point of time. You have expected, yes, it is in uptrend, it will go up, but it has never happened. So that adversity also is a cause of your, or that adversity may be a part of your trading activity. So delta neutral also will minimize that adversity impact on your portfolio or on your trading portfolio if it is being constructed properly. So you have understood delta of these options, call option, put options and future. You have understood what is delta neutral. You have understood three different ways of forming a delta neutral strategy based on the market expectation. The last part, whenever you form this net delta neutral strategy or the net delta you have to keep. So this net delta minimum you have to keep with a range of 30%. So minimum gain you should keep some means 3%. So you can say that means minimum if the underlying asset moves by 1%, I should gain 3%. Minimum you have to keep, and maximum you can keep 30% if you are over bullish on that counter, or if you are encountering there is a stiff correction has happened 5 to 10%. Furthermore, correction is not expected, or there is a stiff rise has happened 5 to 10%. From here, no further rise is expected. So you can form somewhat net delta to the maximum of 30%. So beyond 30%, do not form any strategy which can give you the losses in the strategy. So now I will just exhibit one of the strategy. As I have told you, 8,300 call option. So I am just going to explain this same strategy with the help of our option strategy builder software. So with the help of this particular software, I am going to explain you this particular concept. So here I have just taken the Nifty and I am just going for this means Greek scanner. So here I will be getting which strike option is trading at what Greek, as I have told you. So the delta neutral strategy what we are going to form. So here 8,300 call option, you can say it is quoting at a price of 47, whereas its delta is 0.44, means for each 1% rise in the Nifty, 44% of rise is expected on 8,300 call option. Same way, for each 1% fall in the Nifty, the 8,300 call option will fall by 44%. So if you are getting this particular things, I do not want to take this particular risk. So you are saying that no, 44% is quite high. So if I'll do in this by just looking at this factor, if I am buying 8,300 call option, one lot, and this price what I have given, it is 47 rupees and 50 paisa, and the net delta is 0.44. So 44% risk is there. 44.39 is the net delta. So I don't want to take this 44. So what, after buying this thing, if I sell this 8,400 call option, two lots, so which is quoting at a price of 16 rupees. So I am selling at 16 rupees, two lots. So that delta also is coming to 19.1986. So I sold these two lots. So by this process my net delta has become 44% minus approximately 40%. So I have reduced this delta to 4%. So now if the market fall by 1%, my net delta impact or the decay which will happen in this by 44%. So here also I will get 20% decay out of this 16 rupees. So 4% I will be impacted. Same way, if the price is going up by 1%, my gain will be only on 4%. So here 47% expectation will be there, 32% I'll be losing here, or 40% I'll be losing here. So 3 to 4% only I'll be getting the net factor. So this is how you should form the strategy. So net delta you have reduced to certain extent. So this is one of the way of forming the strategy. So not only this particular factor, you can also see many other aspects of forming this strategy. Suppose you can say that okay, this is the fag end of this particular month. So if I'll see for the November month, suppose November month we are taking. So suppose November we are saying that okay, Bihar election is there, something is going to happen, market is going to go to such and such level. So some are saying that it will go to 8,600, some are saying that it will come to 7,800. So take this view of everyone. Suppose if I am buying one 8,300 call option currently at 157, 8,300 call option, and having a delta now 61%, 61.76. So 61.76 is the delta. So this is the delta of that 8,300 call option. And similar way, if I am also taking a put option, so I have to do the managing the delta will be a different way. I am just going to manage now. So suppose if I am just saying that okay, same 8,300 put option also I am buying at 164. Same way 164 also I am buying one 8,300 put option. This two also having a delta of 8,300 put option, which is having a 41.8,300 put option. So 40.98 we are having. So this much of delta we have given. So now if there is a consolidation, this is 60 will be hit, 40 also will get hit. So to manage that things, suppose if I am going for a December series, suppose I am going for a December series which will be having equal amount of delta, and it is also having some of the delta, means some deltas I can form in this particular order also. Suppose if I can say in this order if I am doing, so 8,300 I bought, 8,300 put option also I have bought. This is for the November I did. I paid 157 and 164. If I'm selling one 8,500 call option, so there 145 rupees I am getting. 8,500 call option I have sold. Call option for December. For December I have sold. I received a premium of 145. So my net premium invested is, so 75 as 2, so 454 as 1. So 12 rupees of the rupee only got involved. However, delta is got managed in a great way. 8,500 call option is having 0.54. So 0.54 of the delta, you sold one lot, so 0.54 of the delta is got reduced from here. So the delta which was call option having 62%, you have reduced to 8%. So this you have reduced to 8%. Also you have managed the premium paid to the market and premium received from the market. So two things you have done. So by forming this cross calendar spread, by the way of purchasing 8,300 call option and selling 8,500 call option for December, you manage the delta to 8%, which was before 61%. You have managed the premium. So premium paid on that thing was 157 rupees. You sold that. By this process you have reduced that premium also by 12 rupees. 12 rupees. Now next part is that similar kind of way. If you are just going for a put option, 8,300 you want. So if you are going for same way 8,100 put option, that too also giving you 143. So 143 rupees it is giving you. So 8,100 December giving you 143 rupees. So you got at 164 here, 143 you are receiving from this premium. So totally you are investing 21 rupees in the premium. And by this process, the previously which was having a 41% of delta, so here also you are having on 25%. So 25% you are selling this one, so it will become positive. earlier you bought it, it is negative. So net by the put side cross calendar bear spread with 8,300 put option November buy and 8,300 put option December sell has reduced your delta to 15. So minus 15. So minus 15 to 16. So you have a plus 8 and minus 15. So minus 7 is the net delta you have derived. So this is how you can, and this is also profit is not compromised. You are also losses also is being compromised in a great order. So I'll just explain the same thing what you have. I have just explained here. So same thing I am going to this cross calendar bull and bear spread. If you see 8,300 call option I bought, 8,500 call option of December I am selling, 8,300 put option of November I am buying, 8,100 put option of December I am selling. Cross calendar bull and bear spread I have found. Premium invested by me is 12 rupees in the call side, 19 rupees in the put side, which will be my maximum loss. And my delta management, which was 62% and 42%, if I could have bought only this 8,300 call and put, that has been reduced to minus 8%, which is a great reduction I have got. If there is a great move happened, it goes to 9,000 and so on. So I'll be earning, so 20, so 31 points is the my losing components and 200 will be my winning component. So 200 minus 31, so 169 points of profit I can win if the price moves in a great way to a 8,900 or 9,000 level. Same way if the price fall back to 7,800 or 8,000 level also, I'll have the like means chances to win maximum 169. So based on the lot size, if you can multiply, so my risk reward works in this order. So 31 rupees I have taken a risk, 75 is the lot size, maximum 2,300 will be my loss risk. So 169 if I can take theoretical, this is theoretical. So if I take 12,000 rupees will be the theoretical profit. So risk reward works out to, so this is the reward you are expecting divided by the risk, you can say. So it is 5%, 1:5 risk reward you have. So risk reward is good. This is a cross calendar bull spread and bear spread. This 200 point is the difference between the strike, Mr. Uttam Jain. So I have taken 8,300 I bought, 8,500 I sold. So only 200 points you can gain from here. If it goes to 9,000 and so. So for that reason only it is being given. Total margin also, total margin will not be a great margin which you can say. So for forming this particular strategy, maximum 35 to 40,000 rupees of margin is required because it will be considered as a spread margin. It will not be a normal margin. Spread margin which will be equal value equivalent to 6% of your total trade value on whatever the trade value. If I am taking 75 is the lot size which is currently intact. So 5 to 6 lakhs rupees worth of this thing is there. So 6 lakhs if you take in all legs, so 24 lakhs on that, you can say 6%. So 24 lakhs if you can take. So this is the 5 to 6% only will be the spread margin into 6% if I am taking. So this is, some brokers will can give you very lesser price also. So it is, though it is coming to some 1,44,000, 1,44,000 based on this thing. However, you can get further down also because it will be considered as a spread margin. So that is 2 to 3% also many will give in that. November it's 75 lot size, that's why it is 1,44,000, but still it is not a bad idea. On 1,44,000 worth of your fund blockage, your risk is 2,300, your winning is 12 lakhs, 12,675. So that is not a bad idea to earn the money in this. So this is or by this process also you can form a good strategy. That 9,000 call option is having 19% as its delta, so 19 into 2, and 8,300 call option is having 62. So by this process you have reduced the delta to 24% by the process of buying 8,300 call and selling 9,000 call option of December. So your maximum loss is capped at 7,000. If you get the profit, profit will be, so 7, if it goes up, goes and expires at 9,000, 9,000, so you can say 700 you can get from 8,300 to this thing. December you are taking, henceforth December will be at a great level, it will be trading. Say that time if you are getting at near about at the end of November, if you are expiring at 9,000 and December contract will be coding at some 140 or 150 level, 150 into 2 if I am saying that. So same 157 also if it is saying 157 into 2 if you are saying that, so then also you will be getting some 386 rupees profit. Consider on the day of November expiry, Nifty is at 9,000. So December contract will be trading at 157 if we are considering this the same value what we are having now. So 157 you have sold at 95. So this process, so your profit will be 576 points you can get. So 576 into 75 you can get some 43 with a risk of 7. So this process also you can do the trade, but your delta is 24%. Earlier cases your profit was less because your delta was only 8%. Here delta is 24%. That's why you are getting this profit. Option strategy software. So this has a trend indicator, it has a Greek scanner, it has net Greek analyzer. So any kind of high flex strategy you can do. And also we have the strategies of some inbuilt strategies like our cross calendar bull bear spread with calendar spread, all these things also we have. So this kind of strategy also we can, you can able to form. So you can able to form this kind of strategies also. So in this cross calendar means in this particular software, so some simulator like of things is being given, so wherein you can form, means it can form the pair and you can choose the best pair among that. So this is one of the simulation I am saying about 5 by 2 calendar spread, and that strategy is explained here. What is that strategy? So October 8,300 call option 5 lots you are buying, 8,300 call option of November 2 lots you are selling. So this is how your strategy will be giving you net investment and profit and loss at different price points. So similar way, many different strategies you can form here. So that is a part of your simulations. So these simulated strategies are nothing but the strategies which I have given on my book on futures and options. Same thing is being programmed here. And you can form user action strategy. So here you can take any of your strategy and you can simulate. Suppose if I am just going for forming one strategy on bank nifty, so say bank nifty I'm going to form one strategy, say for the November month if I'm going to form one strategy. So net delta and other things, the Greek scanner will give me what is the delta and Vega and other things of different strikes. Then I need to say I take some action. Suppose if I am just selling one future and selling a put option, say I'm just selling a put option and selling a future, and I'm buying some call options, say I'm just buying some call options of 18,000, say I'm buying some 2 lots. So by this process I am going to hold for 7 days. So what will be the payoff of these strategies once the bank nifty moves in different territory? So similar way, what will be the losses? So this is user defined strategy you can get in this. You can also manually input the data, whatever the IV, YV you are having, and percentage of increment in the IV, percentage of decrement in the IV, everything manually you feed, you can do it. You can have a save and compare. Suppose today you have formed a strategy, you saved it, so post that you have to load. load the strategy. So what is the strategy you have taken? So you have what is the strategy you have taken? You load it, and same strategy you can simulate here. So when you have taken, what was the Greek big things was there, what is the current Greeks and other things, so that you can form a formulated means adjustment in that. So lot many things you can get in this strategy. It is a very fantastic tool for the strategic traders. So this is one of the tool for advanced option trading we have. Besides that, we have many other educational materials, uh, futures and option course. We have intraday courses and other things. If you wish to take all these things together, including this particular software, it comes at a price of 17,500. And this option strategy software, what I have shown you, it comes at a price of 10,500. And other products having its own pricings. So any query related to the product, you feel free to call in this number. Our sales numbers are given here, so you can feel free to call in this number. So this is on option strategy tool. Yogi has asked a very good question here. So he is telling that whether the delta neutral strategy I am forming, whenever I am forming, whether it will be affected by Vega and Theta. So this is the thing he is asking now. So this delta neutral strategy, whenever you are forming, definitely it will get affected by Vega and Theta, because you are not managing the Vega and Theta at all. So whenever you are forming a Vega neutral strategy, you must manage the Vega. So before forming the strategy, you must have to fix up an objective. Why I am forming a Vega neutral strategy? Means the volatility of that underlying instrument is quite high, which is not going to be sustainable till the expiry. So let me have a negative Vega strategy which can give me some profit, or the volatility of the underlying asset is very low, so let me form a strategy which will be having a net positive Vega, so I should be get benefited when the volatility of the instrument rises. Theta neutral strategy, whenever you are forming, you must have the things. Yes, it is the beginning part of the series. Vega is high, IV is high, and for that only the theta time value on different options are very high. So let me have a strategy which is having a net negative theta, so that I should be benefited from the time value decay. So your objective, you have to fix it before. So it is not that you should always form delta neutral, always form Vega neutral, or always form theta neutral. You have to, for that reason only I have told you, to be a successful option strategy trader, you must understand the Greeks very well. Then you must see that what Greek is utilized for what purpose. Then you fix up your objective. If I am forming a delta neutral strategy in Nifty now, why? Because Nifty volatility is lesser, it is now 10 to 11%. I am expecting there should be a growth in this volatility. So that's why I am forming that. So whenever I am forming a particular Vega neutral strategy in Reliance, so I am thinking that yes, result is expected. So post result, this Vega is going to fall. So I will be getting benefited from the time volatility decay. So for that only I am forming. So your objective is very essential before forming a strategy.